Here's something most freelancers don't know. There's a deduction sitting in the tax code that can cut your taxable income by up to 20%. Not 5, not 10, 20%, where it starts up just for being self-employed. It's called the QBI deduction, and according to the IRS, it was used by roughly 22 million taxpayers in a recent filing year. But here's the problem. The law that created it, the Tax Cuts and Jobs Act, is scheduled to expire after December 31st, 2025. As of right now, in 2026, Congress has not passed a permanent extension. That means this deduction could be on borrowed time. If you're a freelancer and you haven't built your 2026 tax strategy around Section 190A, this video will show you exactly how to use it while it's still on the table. What the QBI deduction actually is. Let's start with the basics, and then I'll explain why most freelancers don't take full advantage of this. Section 190A of the Internal Revenue Code was created by the Tax Cuts and Jobs Act of 2017. It lets owners of pass-through businesses, sole proprietors, single-member LLCs, S-corps, partnerships, deduct up to 20% of their qualified business income. That's income from your freelance work, your consulting, your creative projects, not wages from a W-2 employer. Here's what that means in real dollars. If your net self-employment income is $80,000, the QBI deduction could reduce your taxable income by up to $16,000. At a 22% federal tax bracket, that's roughly $3,500 back in your pocket. The IRS doesn't send you a check, but you pay that much less at tax time. The deduction is taken on your personal return using Form 8995 or the more detailed Form 8995A, depending on your situation. It reduces your taxable income, not your self-employment tax, which stays put. That distinction matters depending on your income level and filing status. Now here's the part that trips people up. The deduction isn't automatic at every income level. There are phase-outs and hard cutoffs, and whether you hit them depends on how much you make and what kind of business you run. Let's get into that. Who qualifies and who gets phased out. For most freelancers with moderate income, qualifying is straightforward. If your total taxable income in 2026 is below $197,300 as a single filer, or $394,600 if you're married filing jointly, you can deduct 20% of your qualified business income with no strings attached. Those are the 2026 thresholds, and the IRS adjusts them annually for inflation. Below those numbers, your business type doesn't matter. You could be a freelance graphic designer, an independent plumber, a Uber driver, or a self-employed accountant. You qualify. Above those thresholds, the rules get more complicated, and for one specific group, the deduction phases out entirely. That group is called Specified Service Trades or Businesses, or SSTBs. The IRS defines SSTBs as businesses where the principal asset is the reputation or skill of the owner. That covers fields like law, consulting, financial services, performing arts, and health. If you're a freelance consultant or an independent financial coach and your income exceeds those thresholds, your QBI deduction starts to shrink and eventually disappears. My take, if you're close to the phase-out range, this is the most important tax number you'll optimize around in 2026. I'll show you exactly how to do that in a moment. There's one more layer here. For high earners above the thresholds who don't run an SSTB, think a freelance software developer or independent contractor in construction. The deduction doesn't disappear, but it gets capped. It's limited to the lesser of 20% of QBI or 50% of W-2 wages paid by the business, or 25% of W-2 wages plus 2.5% of qualified property. That's the wage and property limitation. Most solo freelancers with no employees and no significant business property will hit that cap. But there's a workaround, and it involves your business structure. More on that next. How to actually calculate your deduction. Here's the calculation in plain terms. Start with your net self-employment income. That's gross revenue minus legitimate business deductions. According to the IRS, that net figure is your qualified business income, or QBI. Multiply it by 20%. That's your preliminary deduction. Then compare that number against your overall taxable income limitation. The total QBI deduction you can take cannot exceed 20% of your total taxable income minus net capital gains. So if your taxable income is $70,000 and you have no capital gains, your ceiling is $14,000. Your business QBI deduction can't go above that, even if your business income alone would support a higher number. For single filers under $197,300 and joint filers under $394,600, that's basically the whole calculation. Run the two numbers, take the smaller one, enter it on Form 8995, done. Above those thresholds, you'll use Form 8995A, which applies the phase-out rules and the wage and property limitations. This is where a good tax professional earns their fee, especially if you're in an SSTB. Your filing status, your total income, your spouse's income if you're married, all of it changes the math. But the framework is the same regardless of situation. Know your QBI, know your taxable income, know which box you're in. One thing worth flagging, losses matter here too. If your self-employment business ran a net loss in 2025, the IRS carries that forward and nets it against your 2026 QBI. That reduces your deduction. Track this number. It affects what you're actually allowed to deduct this year. Strategies to maximize your QBI before sunset. This is where I want you to pay close attention, because if the TCJA expires without a permanent extension or replacement, this deduction goes away. You have 2026 to use it aggressively. Here's what I'd do. First, reduce your taxable income below the phase-out threshold if you're near it. The most effective tools are a SEP IRA, a solo 401k, or a simple IRA. According to the IRS, solo 401k contributions can reach up to $70,000 in 2025, with the 2026 limit expected to increase slightly with inflation. Contributions to these accounts reduce your adjusted gross income, which flows directly into your taxable income calculation, meaning they can pull you back below the QBI phase-out threshold. If you're a single filer sitting at $215,000 in taxable income, maxing a solo 401k could drop you under $197,300 and restore your full deduction. That's a real immediate legal move. Second, if you're an SSTB freelancer above the threshold, the right move is to get serious about your business structure. Some solo workers convert to an S-Corp specifically to pay themselves a reasonable W-2 salary, which creates W-2 wages in the business and unlocks the wage limitation pathway to the deduction. This isn't right for everyone. If your net income is below roughly $80,000 to $100,000, the S-Corp payroll costs often outweigh the tax savings. Your specific numbers determine whether the math works, but if you're clearing $150,000 or more as a freelancer, it's worth running. Third, accelerate legitimate business deductions into 2026 now. Every dollar you deduct as a business expense under Section 162 reduces your QBI, yes, but it also reduces your self-employment tax base, which is a separate 15.3% hit on net earnings, according to IRS Schedule SE. Don't confuse reducing QBI with reducing your deduction. More deductions equal lower net income, which equals a smaller QBI base to work from. But the SE tax savings usually more than compensate. Run the actual numbers for your income level. Fourth, and this is the move most freelancers skip, plan your income timing. If you're near the phase-out threshold, defer invoicing to push income into a lower year, or accelerate income into 2026 before any potential legislative change eliminates the deduction entirely. I help solo workers and gig workers stop overpaying the IRS. And this timing decision is one of the highest leverage moves you can make before year end. The data is clear. The QBI deduction rewards freelancers who plan. It does nothing for those who file reactively. Where things stand with the TCJA sunset. Let's talk about the elephant in the room. The Tax Cuts and Jobs Act provisions, including Section 199A, were written with a built-in expiration at the end of 2025. As of this recording in 2026, Congress has not passed legislation that permanently extends or replaces the QBI deduction. Legislative proposals are in motion, but nothing is signed into law. What does that mean practically? The IRS is still administering the deduction for tax year 2026 returns, so you claim it. Do not skip this deduction because you're uncertain about the politics. That would be leaving real money behind while waiting for certainty that may not come. At the same time, do not assume the deduction survives indefinitely. Build your 2026 tax plan as if this is the last year it exists. If Congress extends it, that's upside. If they don't, you've already maximized the benefit while it was available. That's the right strategic posture. According to the Tax Foundation, the QBI deduction reduced federal tax revenue by an estimated $60 billion in a recent year, which tells you how much money is moving through this provision. There are strong lobbying forces on both sides, but your job isn't to predict Congress. Your job is to act on what the code currently allows. Disclaimer in CTA. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this video helped you get a clearer picture of the QBI deduction, hit subscribe. I cover the tax and financial strategy that solo workers actually need without the jargon. And drop a comment below with the freelance tax or money question you want me to dig into next. I read every comment and build upcoming videos around what this audience is actually dealing with. Next week, I'm covering startup costs for new freelancers, specifically which expenses you can write off when you're just getting started, and the one mistake that disqualifies them entirely. You won't want to miss that one. And if you want a tool to help you track deductions and estimate quarterly taxes without a spreadsheet, check the description for the tax software I actually use. This video may contain affiliate links. I only recommend tools I use personally.